I put $5,000 into a brokerage account, and over the next 30 days, I placed 283 trades, sometimes holding a stock for 90 seconds, sometimes 90 minutes. At the end of the month, here's where I landed. Down $80. 80. And I already know what you're thinking. So basically, nothing happened. But that $80 number is the least interesting part of this whole story. Because what happened in between nearly broke my brain and taught me more about money than 3 years of reading ever did. So here's the deal. For 30 days straight, I traded the markets like it was a full-time job. Every single trading day, I sat down before the open. I scalped. I day traded. I journaled every position. Wins, losses, panic, all of it. No edited highlight reel. No look at this one amazing trade. Just the boring, sweaty, honest reality of what it actually feels like to do this for a month. And in this video, I'm going to give you the whole thing in 3 parts. First, I'll explain what day trading and scalping actually are, in plain English. So even if you've never bought a single share, you'll get it. Second, I'll walk you through one real trade, tick by tick, so you can see exactly how the money moves and where it quietly leaks out. And third, I'll break down the 5 mistakes that absolutely wrecked my week 2. So you can skip the part where I lost over $1,000 in 5 days. By the end, you'll understand day trading better than most people who've already opened an account. Let's get into it. Okay, foundation first. Day trading just means you buy and sell a stock within the same day. You never hold it overnight. By the time the market closes, you're in cash. Scalping is the most extreme version of that. You're hunting tiny moves, sometimes just 10 or 20 cents per share, and you might be in and out of a trade in under 2 minutes. The whole game is small wins, repeated many, many times. Now here's the part nobody puts on the thumbnail. Every single trade has 3 hidden taxes working against you. Number 1, the spread. That's the tiny gap between the price to buy and the price to sell. Number 2, slippage, when the price moves a hair before your order actually fills. And number 3, fees and commissions, which might look like 0 on a flashy app, but trust me, the spread is paying for that free. Let me make it concrete. Say a stock is sitting at $40. To make $100 scalping, I might need a 30-cent move on 300 shares. Sounds easy, right? But the spread and slippage might quietly eat 4 or 5 cents of that on the way in and on the way out. So a move that looks like 30 cents on the chart only puts 22 cents in my pocket. Multiply that across 283 trades, and those pennies turn into real money. Money that's leaving your account whether you win or lose. This is the thing beginners never understand. In day trading, you're not just betting on direction. You're fighting a built-in headwind on every single click. So to come out ahead, you need 2 things at once. You have to win often enough, and your average win has to be bigger than your average loss. Get only one of those right, and the math still drags you backwards. That headwind, by the way, is the entire reason I finished the month down $80 despite having a winning week 1. Hold that thought. Let me show you what an actual trade looked like, because this is where it clicks. I'm going to walk you through one scalp from day 4, a clean one, a winner, and then I'll show you what the exact same setup turned into on day 9, when I lost my mind. Day 4. I'm watching a $40 stock that's been grinding upward all morning. I decide to buy 200 shares at $40.20. My plan is simple and written down before I click. Target $40.50. That's a 30-cent gain. And a stop loss at $40.05. So if I'm wrong, I'm out for a 15-cent loss. That's a 2-to-1 setup. I'm risking $30 to make 60. Good math. I click buy. But because of slippage, I actually fill at 40.22, not 40.20. 2 cents gone already. The stock ticks up, hits my target zone, and I sell. But again, slippage. I exit at 40.46, not 40.50. So on paper, this looked like a 30-cent winner, worth $60. In reality, I made 24 cents a share, times 200 shares, $48. Still a win. But $12 of my profit just evaporated into the spread and slippage. That's the headwind I told you about in real life. Now, day 9. Same stock, same kind of setup. I buy 200 shares, and this time, the price drops. My stop loss at 40.05 gets hit. I'm down $30. Totally normal, totally fine. That's the plan working. But I was already down on the day, and something in my brain went, I need that back now. So I broke my own rule. I jumped right back in, but this time with 400 shares instead of 200, because if it bounces, I make it back twice as fast, right? It didn't bounce. It dropped another 40 cents while I sat there frozen, refusing to sell, telling myself it would turn around. By the time I finally bailed, that one revenge trade cost me $310. One trade. And then, because apparently I learned nothing, I chased 2 more. That single afternoon is most of why week 2 went from 5,600 down to 4,570. The setup wasn't the problem. I was the problem. That day 9 disaster wasn't one mistake. It was 5 stacked on top of each other. So let's break them down, because if you only remember one section of this video, make it this one. Mistake 1, revenge trading. Trying to instantly win back a loss is the single fastest way to turn a small bad day into a catastrophic one. The fix is almost stupidly simple, a hard daily loss limit. I now stop trading for the day the moment I'm down 2% of my account. On a $5,000 account, that's $100. Hit it, and the laptop closes. No exceptions, no one more. Mistake 2, blowing up your position size. Doubling from 200 shares to 400 to make it back faster doesn't make the math faster. It makes the damage faster. The fix is the 1% rule. Never risk more than 1% of your account on a single trade. On $5,000, that's $50 of risk max per trade. That one rule alone would have saved me most of week 2. Mistake 3, ignoring or moving your stop loss. On day 9, I had a stop, and then I mentally deleted it because I felt it would bounce. A stop loss you won't honor isn't a stop loss. It's a suggestion. The fix, set it as an actual order the moment you enter and treat it as untouchable. Mistake 4, overtrading. In week 2, I made almost 100 trades in 5 days, way more than any real opportunity existed for. I was trading out of boredom and emotion, not because the setup was there. The fix is a checklist. If a trade doesn't meet your written criteria, you don't take it. Fewer, better trades beat more, worse ones every single time. Mistake 5, not journaling. For the first 9 days, I barely tracked anything, so I kept repeating the same errors blind. The moment I started writing down every trade, the entry, the reason, the emotion, the result. My behavior changed almost overnight. That journal is the only reason. Weeks 3 and 4 were calm and slightly green instead of more chaos. You cannot fix a pattern you can't see. Now, real quick, if any of this is making day trading make sense for the first time, do me a favor and hit that subscribe button. This is part of a full series where we go deep on day trading and scalping, step by step, and I'd hate for you to miss the next one. And because rules only work if you actually use them, I put the exact tools I built during this experiment down in the description for you. My trading journal template, a position size calculator that does the 1% math automatically, and the pre-trade checklist I mentioned. They're all linked below, completely free. Grab them, use them, and you'll already be ahead of where I was on day 1. So after 30 days, 283 trades, and finishing $80 in the hole, what's the one thing I'd actually tattoo on my brain? It's this. Day trading is not won by predicting the market. It's won by surviving yourself. My winning trades and my losing trades came from roughly the same setups. The difference between my green weeks and my disaster week wasn't skill at picking stocks, it was discipline. Risk management, knowing when to close the laptop. The market didn't take my money in week 2. My own emotions did. If you take nothing else from this, take that. Protect your downside, control your size, and let the wins take care of themselves. In the next video in this series, I'm going deeper on the single rule that saved my account. I'll show you exactly how to use the 1% risk rule and position sizing to design a trade so that no single loss can ever blow you up, even on your worst day. It's the math behind staying in the game, and once you see it, you can't unsee it. I'll see you there. Quick note before you go. This video is for education only, and nothing here is financial advice. Always do your own research before risking real money. And that's a wrap on today's topic. If you found this helpful, be sure to hit like and subscribe so you never miss a lesson. Have a question about what we covered today? Drop it in the comments below. I'll be answering the best ones. If you want to dive even deeper, click on this next video right here, where we explore next topic. Thanks for learning with me today, and I'll see you in the next one.